Joining us now is Jefferies Chief Market Strategist David Zervos and Richard Bernstein Advisors Director of Fixed Income Michael Kontopoulos. Good to have you both here. David, I'll start with you because we have been getting a flurry of Fed speak. We also got the beige book this afternoon, but perhaps what's getting the most attention has been the hotter than expected ISM services number. What does it say about inflation? What does it say about the Fed? What does it say about stocks?
Morgan, in the big picture, it says the same thing that we've kind of been learning all year, which is that forecasts of a recession, which the beginning of this year were supposed to be now, are just way off mark. And people have had to be on their back foot, kind of readjusting portfolios and readjusting forecasts all year. I think that's why we're up. That's why everybody's chasing the market. The recession has been priced out. And I think what the market's maybe forgotten is that as you price that out, you've got a Fed that's just going to be higher for longer and keeping real rates more restrictive for longer. And I'm not sure that the market's priced that in as much as the reduced risk of the recession. And that's why you've got some weakness coming back into the stock market and maybe have a little bit more to go.
Yeah. Michael, your thoughts on this and how it's playing out in fixed income, whether it's the bond market or even the fact that we do have this surge of corporate issuance upon us right now?
Yeah, we certainly have. I mean, I think much of yesterday's move in yields can be attributed to that surge in corporate issuance. I think David's absolutely right. The market's probably underappreciated the economic strength that we've seen, the pricing out of a recession. Who knows when that will be and if it will ultimately come. The data has certainly been stronger, but I also wouldn't say it's been unequivocally strong. I mean, it's been more mixed is the way I would say it. And as a consequence of more mixed data, I think what investors need to be thinking about is having a more balanced fixed income portfolio. You hear a lot about, cash rates being so high, being able to earn 5% in T-bills or CDs, but there's a lot of opportunity in fixed income that's getting overlooked at the moment. And so I think as the Fed remains tight, real yields remain high, and opportunities start to present themselves in various pockets of the fixed income market, there's a lot to be done here to deliver real return to clients.
So, Michael, let's talk about specifically what that is, because too often we talk about yields just in terms of what they do to stocks, but it also often means that some interesting bonds are trading at some really interesting entry points and not just CDs and T-bills. So what should investors do, especially if they're out of balance in their portfolios, as so many are, and have been leaning too hard into equities?
Yeah, absolutely. I'd say equities and cash, right? I mean, that's where you've seen the big lean. And cash in particular is meant to be dated, not married. Let's be frank. When you came into the year, the options available to investors were pretty minimal from a fixed income point of view. You could buy duration and hope that yields fell, or buy floating rate paper and hope that the Fed hiked rates aggressively. But credit was tight, both high yield and IG. Bank loans had their issues. Mortgages didn't look particularly attractive. Really, since SVB, things have changed pretty dramatically. Now you have opportunities in things like preferreds and high-quality structured products like CLOs, yielding 6.5%. Mortgage-backed securities have now become attractive as you've lost some of the key buyers in banks and the Fed, and spreads have widened pretty substantially and certainly look attractive from a vol-adjusted basis. And so there is a big opportunity here in a lot of different areas of fixed income, not just cash. And that's what I was saying earlier, that you need to have balance, right? I mean, you need to not just own one area of the market, but spread the net a little bit wider, cast the net a little bit wider, and take advantage of both yields, which are attractive, as well as total return opportunities, i.e. price appreciation.